Ever find yourself jumping into a trade way too early? You hit buy, and boom, the price instantly reverses. If you are tired of guessing and want to know how the world's top traders use actual math to find their exact entries and exits, you are in the right place. Today, we're mastering the Fibonacci tool.
It's literally the most painful feeling for retail traders, right? Buying at the absolute top or just completely missing a bounce. You see a huge push, you get major FOMO, you jump in, and the price just drops like a rock. It's like there are these invisible lines on the chart that everyone else can see except you. Well, there's actually a mathematical solution to this chaos.
You see, it all comes down to the Fibonacci sequence. 1, 1, 2, 3, 5, 8, and so on. You basically just add the last two numbers together to get the next one. This exact mathematical ratio shows up everywhere in nature, from seashells to whole galaxies. But what's really wild is that these exact same ratios act as hidden areas of value on our financial charts. They identify precisely where the big institutions look to add to their massive winning positions.
Here is our roadmap for today's explainer. Introduction to the magic, setup and drawing, high probability zones, extensions for profit, confluence strategy, and finally, summary and psychology.
All right, let's kick things off with part 1, Introduction to the Magic.
So, why do the big players rely on this tool so much? It's all about finding those discount areas. When a price surges, everyday retail traders usually panic, chase the breakout, and pay a premium. But the smart money? No way. They wait for a discount. They wait for the price to pull back to a very specific mathematical equilibrium before launching the next big move. We use Fibonacci retracements to find exactly where that discount is, and extensions to find highly profitable profit targets.
Moving on to part 2, Setup and Drawing.
Okay, before you trade, your tool desperately needs a makeover. By default, it looks like a cluttered finger painting, right? Let's fix that. Step 1, ditch the background colors and price labels to cut through the noise. Step 2, switch the levels to percentages so they're easier to read. Step 3, bump up the font size, shove the labels to the right side of your screen, and thicken up those lines. And step 4, this is crucial, color code your levels. Keep your 0%, 23.6%, and 100% black, but make the 50% and 61.8% levels a bright red or gold. Those are your absolute highest quality zones.
Now, how do you actually draw this thing? This is where so many beginners mess up. If you're looking at a clear uptrend, you click on the recent swing low and drag your mouse all the way up to the recent swing high. If you're in a downtrend, just do the exact opposite. Click the recent swing high and drag it downward to the recent swing low.
And here is the golden rule you absolutely need to follow. Always draw from wick to wick. I know some traders like to debate using the real body of the candle, but honestly, wicks show you the absolute extreme highs and lows the price physically reached. It tells the full, unfiltered story of exactly where liquidity was grabbed. Whatever you do, just be consistent.
Let's dive into part 3, high probability zones.
So, which percentages actually matter? Let's start with the 38.2% level. This is your shallow pullback. You are going to see this level respected a lot in super aggressive, strong trends. When there is massive momentum, the price just won't drop very deep. Buyers step in early, it bounces right off that 38.2% and keeps skyrocketing. Next up is the absolute sweet spot, the golden zone, sitting right between 50% and 61.8%. That 50% mark is pure equilibrium, literally a 50% off discount for buyers. Institutions absolutely love this zone. They will deliberately let the price drift down here just to shake out the weak hands and grab stop losses before aggressively reversing the market. Drilling down just a bit more, we hit the golden pocket between 61.8% and 65%. A lot of pros treat this narrow sliver as the absolute strongest area for reversal. But hey, pay close attention to that 100% level at the bottom. If the price drops past 100%, it is no longer a retracement. That's a full trend reversal, and your trade setup is officially completely dead. Don't try to buy that dip. Next up, part 4, extensions for profit. Look, getting a great entry is only half the battle. If you don't know when to actually exit, you are leaving serious money on the table. For this, we swap over to the trend-based Fibonacci Extension tool. Instead of looking at the past, this tool projects into the future to give us our profit targets. It takes 3 clicks, the swing low, the swing high, and exactly where that pullback ended. Your first target is the 100% level. This is the measured move objective. It basically means this brand new leg of the trend is the exact same length as the first impulse move.
You absolutely want to take some profits here, mainly because institutional algorithms are quite literally programmed to automatically take profit at these exact 1-to-1 ratios. For target 2, we're looking at the 161.8% extension level. This is a massive exhaustion point. Once a trend pushes this far past the original move, it usually runs entirely out of gas and violently reverses. It is the perfect spot to close out the remainder of your trade, pat yourself on the back, and just walk away with your profits.
Which brings us to part 5, confluence strategy.
Okay, listen closely to this. Don't just buy blindly because the price touched a line. Seriously, this is a huge trap for beginners. You see the price drop down to the 50% line, you instantly panic buy, and it just crashes straight through the floor. You absolutely have to wait for the market to prove that buyers are actually stepping in and that the level is holding.
This is where your confluence checklist comes in. First, look for candlestick confirmation, like a long lower wick showing immediate rejection or a big bullish engulfing candle right at that Fibonacci level. Second, check for support and resistance overlap. Does your Fibonacci line sit right on top of an old resistance ceiling that's now acting as a new support floor? That is pure gold. And finally, check your time frames. A setup on a daily chart has a way higher success rate than the algorithmic noise you'll find on a 1-minute chart.
Finally, part 6, summary and psychology. Let's bring this all together. Trading Fibonacci is ultimately a game of patience. It's about waiting for the market to come to your discount zone instead of frantically chasing every move. If you can master drawing wick to wick, finding that golden zone, and actually waiting for confluence, your trading is going to change. It'll instantly feel a lot less like emotional guessing and a whole lot more like calculated, unemotional math.
So now that you've got this ultimate institutional playbook, the real question is, do you have the discipline to wait for the market to come to you, or are you going to go back to gambling? Thanks for joining this explainer. Go back test these techniques, watch the math unfold in real time, and we'll see you on the next one.